ladies and gentlemen, he was also part of a very interesting panel. And with that, ladies and gentlemen, can we have an interesting round of applause to welcome back again, once again, Mr. Shyamsunder. Over to you, sir.
Good afternoon. Wow, that was an amazing session. Found that very interesting, and I hope that my topic will also add to some of the discussion which you've already had. Now, at the outset, I want to confess that I've been having a bit of a hangover. Not that kind of a hangover. This is a hangover from watching too much of the Berkshire Hathaway annual general meeting. So the title slide is taking on what Charlie Munger of Berkshire Hathaway says, to invert, always invert. When you're faced with a question which you want an answer to, invert it, and then you may get the better clarity. So the question which we are asking is that in the context of asset allocation and rebalancing through passives, who wants to be average? And our contention is that being average is a virtue when you're talking about the long term, particularly in terms of the context of the strategic asset allocation which we're trying to do. In that context, what we are looking for, what we in fact look for, is a consistency. And that's what passives can deliver. So this is something which is well known to most distributors and advisors on the need for asset allocation and what you look for in each of these. Now, for most of these parameters, when you're talking about time horizon, risk appetite, goals, passives, and a lot of the participants today have already spoken about the diverse set of assets or of asset categories that passives today cater to. And with that in mind, what we are saying is that active investing exposes you to an additional risk. Now, the question for each of us is whether we want to take that risk. And that depends on the risk tolerance, risk appetite of the clients. Active risk is something which can generate the rewards as well, if currently identified, and the suitable assets and the manufacturing and the products are available for it as well. So that is a point. For constructing long-term strategic allocation, passives can play a very significant role in constructing this. So I'll move on, but before that, we've already played one round of quizzes. I want to ask another question, another quiz. Which was the first index fund to be launched? Which company launched the first index fund? Any guesses?
India?
No, in the world. No, that's not the answer. Vanguard is the most common answer, but the actual answer is Wells Fargo. So Wells Fargo was the first one to establish an index fund, actually, and a bit of history on this, and I'm going to say this to illustrate how far asset allocation and index funds itself have come. They set up this $6 million fund for Samsonite. That was the first index fund, and it was a flop. A flop. It did not deliver the returns that was expected of it. The reason for that was that a very interesting reason, that it was an equal-weighted fund. And at that time, the transaction cost of continuously rebalancing the equal-weighted fund was so high that it meant that it underperformed all the active funds. Today, we have reached a situation where that is not the case, where the transaction costs have fallen, and you do have equal-weighted funds which are running pretty successfully. So that's an instance of how reduction of transaction costs and the wider financialization of the services that we have today have enabled a lot of the passive investing, and that's something which we don't talk about a lot. Today, of course, we have talked about a lot of how the index funds in India and the passive movement have grown tremendously. But in my presentation going forward, I will be referring a lot to what's happened in the US. And I use that because today, as you're saying, the history in the Indian markets are pretty recent in terms of the growth, right? So I want to look at when we are looking at strategic asset allocation, what I want to ask is that are these trends enduring or are they fleeting? How do we know? They've looked at the performance which Koel and a team have put out at Spiva. But will they stay for the longer term? Are they something which has just happened in the near term, or can we bank on them to continue for 10 years, 20 years? So, I lay out a few reasons why you might want to avoid passive funds, or some reasons why passive funds may be less desirable in a sense. And I will look to invert them again to try and arrive at greater clarity. So the first point is, I'll dive right in 3 points which I'm going to discuss. Risky in the sense that when markets fall, you do not have the chance to outperform. You do not have the chance to fall less. So it is risky in that sense. Active fund can maybe help you prevent that from happening. Second is that you are condemned to holding losers, condemned to picking bad stocks in the index fund. And that is not good for our long-term planning. Third is that it's skilled active management. You can identify the funds which you want to invest in. Start off with the first one. Here the argument is that in the downside, when there's a downturn in the markets, active fund management can help you reduce that. However, data has been very mixed, actually. It's not been very consistent. But there is nothing to show that consistently, at least, active fund management has been able to offer downside protection. We've seen multiple, these are the biggest bear markets or downturns in the US markets at least, and it's been a decidedly mixed kind of a picture, which means that this argument does not really work well. Now, one reason why active funds can do a bit better is that there tends to be a discretion around cash holding. So doing the simple math, if you have a 20% decline, which is what a bear market is considered to be, and you're holding 5% in cash, that gives you a 1% lift in performance directly, which would mean that can recover the expenses at least and bring it much closer in the equation. But that's not a call for active fund management, that's a call for asset allocation actually. You would prefer to then hold more cash rather than playing cash through the holding of an active fund. So this is one argument. Now, second argument is that passive funds pick losers. Now, here our point is that when you're in the context of multi-year planning, we're looking at wealth creation. We're looking at how to make long-term wealth. And here what we should be looking at is the stocks which will make money. Consistently what has come out is that a small set of stocks decide the winners. You miss out on them, you miss out on a lot of the wealth creation. Holding an index ensures that you capture all of the wealth creation opportunities. And that is more powerful than the losers which we acknowledge that you will end up holding. In the Indian context, I've done this study on multiple time horizons, 5 years, 10 years, and I've also found that out of the top 500 stocks at any point of time, about 2/3 of stocks underperform. So 30 to 35% of stocks in any period are the ones which create all the wealth. So that's a point, that you should own the winners rather than worrying about the losers. Now, third point about active fund management. One is a brief point about what does it statistically mean for a fund manager to be lucky or not. And the benchmark is very high here. It's very tough to figure out whether it's luck or skill. If we are looking at fund managers, they do become lucky, and that's a good enough outcome, I think. But what I think Koel was also referring to in her discussion was about persistency. Can you pick the fund performer by looking at what has done well? And what we have found is that even in the Indian markets, if you look at 3-year time periods, so we looked at 2013 to 16, the funds which outperformed, the top 25%. next 3 years, how many of them carried through to the next 3 years? 40% of those carried through. We looked at the subsequent 3 years. None of them are there in the original. Your ability to pick the next winner is difficult. And finally, on the point of skilled active fund management, I point to one of the anomalies in terms of generation of alpha. Peter Lynch, who ran the Magellan Fund from 1977 to 1990. Fantastic returns, 29% CAGR versus the S&P of about 15%. Now, the point here is that you want to pick, if you're picking a fund manager, you want to pick a Peter Lynch from 1977 to 1980, and then ride for the next decade, because then you'd have had 22% return versus 15% for the index. But we suspect that most of, the problem for what Peter Lynch found out was that his fund size ballooned from $100 million to $16 billion. And as that fund size kept on growing, the amount of alpha which he generated kept falling. What that ended up meaning was that at 1990, he quit the industry. At this point, I will also point out that he is still a strong votary of active fund management, though the other person, coming back to the original hangover which I had of the Berkshire Hathaway, Warren Buffett and has not been that much of a votary of active fund management. And just a few thoughts which they have repeatedly said about how index funds and passive investing should play a critical part in terms of your asset allocation longer term.
Well, Hari, I'm just going to quickly check if you have any questions. I do see here one. Yes, sir.
Hi, good afternoon.
Good afternoon.
You mentioned in your example that they have not been able to the large cap. Why is the focus always on large cap? Why don't I give money to a fund manager and say, boss, this is the money. You decide large, small, micro cap, and give him the freedom. We tell him, you take this, and then you start comparing the performance. It won't, no? Everything won't perform equally well. So if you're giving him the mandate to the fund manager that, boss, this is my money, manage it.
Sure.
And we as investment advisors, we manage the asset allocation. Sure. Wouldn't that be a good combination? So I'm not getting into this active passive. I'm saying more focus is on the asset allocation, which is what even the speakers have been saying, and you also will agree that 90% of your returns come from the asset allocation. So why too much emphasis on passive active?
Yeah, I think that's a fair point. And I agree on particularly one aspect on that, which is that today the index does not outperform most of the small cap. If you've seen right from the start of the day, nobody has mentioned the word small cap all through day, right? Because it is true that small cap indexes don't beat the small cap active manager, and there are good reasons for it. The reason why there's so much emphasis placed on large caps, is that 78% in terms of market cap is out of top 500 is with the large caps. So when you're talking about scalable products, when you're talking about the industry itself, you will end up having to talk about large caps. And so that's why the conversation always comes around to what percentage of your asset allocation is going to be with large caps. And longer term also, in terms of the volatility, it is something which you want to be in. So I think that's why the conversation keeps coming back to that.
Till date, none of my clients have ever asked me why you're putting in scheme A or scheme B. I just tell them this is your goal, this is the process.
No, that's fair. I think that's absolutely fair. But in terms of, just looking at the overall, if everybody did what you did, then the small caps would run up as much. So I think the alpha would be taken out from there as well.
Any further questions, ladies and gentlemen? All right, then on that note, can we have a huge round of applause one more time to thank Mr. Hari Shyamsunder. Thank you once again.
Thank you.